right, welcome back to day 14 or way number 14. Hard to believe we're almost halfway through this month of 30 ways that you can get started in real estate investing. Now, yesterday we talked a little bit about subject to or purchasing property subject to the existing financing. Now, here's a way that structured properly can benefit both the seller and the buyer, you as the investor, for purchasing a property that has no debt tied to it. The owner, has paid off their mortgage, they own it free and clear. And for whatever reason, maybe they're a retired landlord, maybe they need the funds for something else, or they just want to, be done with property management, retire, whatever the case may be. So now this goes by a couple of different names depending on the jurisdiction. One of the most common ones is contract for deed. And this is what's called here in Minnesota, sometimes CFD for short. There's a lot of different euphemisms and other options that are available in other jurisdictions: real estate contract, land contract, notice of purchaser's intent, trust indenture, or it might even just be a setup as a standard mortgage, but there's just a private seller and private buyer involved. There's no banks involved. But today we're just basically we talked about a contract for deed, and the legal term for this is a seller-backed financed instrument. So we're going to kind of walk through an option here and how this works. So you as the investor are here. And yes, I know I have astounding good drawing capabilities here. But you as the investor are here. There's a property that is paid off, free and clear, no mortgage. And we have the seller over here. And you learn about this, passing through on your network. Maybe you're friends with the seller. Maybe you know someone that knows the seller. But regardless, you find out, you as the investor understand that this seller has a property for sale. Now, maybe you're looking right at it. It's like, well, geez, even if I did a down payment, gosh, I'd really like to buy this property, but I just don't have the funds available for it. And gosh, he owns it free and clear. I'm sure he just wants the cash right out. But, sometimes it just doesn't hurt to have a conversation, see where things are going, and what does the seller really want? Now, maybe you just have a conversation with the seller. And it's like, well, let's say you sell this property for $100,000. What are you planning on doing with the proceeds? What is your what's your end game look like? What are you hoping to do? And maybe through your conversations, you find out that the seller has owned this property for many years, has taken depreciation allowances, maybe just had this property at a steal of a deal years and years and years ago. And now they're looking, it's like, well, gosh, if I sell this, not only am I losing the rent income because this has been tenanted for numerous years, paying the rent month after month to the owner or landlord. So I'm going to be losing the rental income. I'm going to get a big wad of cash selling this property, but I got capital gains taxes to worry about, and I got recaptured depreciation, maybe some other closing costs to worry about. And on top of that, maybe this person's W-2 job, they had a banner year. So with all this income coming in, the depreciation going away, they might even be kicked into another higher tax bracket. So, like I said, everyone's situation is different, but it's very possible that the seller owns this property free and clear, has owned it for numerous years, but has a lot of depreciation allowances and capital gains taxes that are going to have to be paid. So yeah, they want to sell, they don't want to be a landlord anymore, but gosh, I'm really going to miss that rental income stream, and I got all this, this big tax burden coming up, and I'm going to be kicked into a higher tax bracket. So what in the world can I possibly do? So in this case, you might have a conversation with the seller. It's like, well, what would you feel about being the bank for the property? You own the property free and clear. Instead of me making payments to a mortgage company, what if I made the payments to you? And there's a couple of different ways you can structure this contract for deed. Podcast number 8, where I had Brett Swartz on, we talked about deferred sales trust is another option that you can do with this, potentially save on taxes. So this is essentially how the deal works. If you as the buyer were to come to the seller and say, all right, here's $100,000 for the property, that $100,000 goes in this person's pocket. Now they get kicked up into a higher tax bracket. They got to owe capital gains, recapture depreciation. So they might have a, they might have a 30, 40, maybe even $50,000 tax hits when it's all said and done between their, W-2 job and how their tax return files out. So you go to the seller and say, well, Mr. Seller, what if you're the bank and I paid you or basically bought back the property to you? So the seller still has the deed to the property. So technically speaking, you do not own the property yet. You are making payments to own the property. This is very similar to a mortgage where Bank of America, Chase, your local credit union, whatever the case may be, they have an interest in your property. They have a lien on your property that you do not fully own it per se until you make that last mortgage payment. So in this case, the seller is going to be the bank. Instead of Bank of America doing a mortgage, the seller is basically going to be the bank for this transaction. Now, the nice thing about this is you can be as flexible. You can come to any terms you want that you and the seller can agree on. I'm just throwing a couple different options. Maybe you have a 180-day moratorium or delay for when the first payment's due. Maybe you have interest only for a couple of years. Maybe you have a lower interest period for maybe 5 years and then a balloon payment. So balloon payments essentially work, say you have a mortgage, and you can run this on any mortgage calculator online. Say you have a 30-year mortgage on a $100,000 property, comes to, I can't do that in my head, let's just say it's $400 a month. You pay that $400 a month, goes to principal and interest. And then while it's on a 30-year amortization, it's not a 30-year term. At a 5-year mark, there's a balloon payment due, or essentially the remaining balance is due. Again, you can structure this however you want. But let's just say for simplicity's sake, Mr. Seller has, maybe this year they had a banner year on the W-2 job. It's like, pretty much any amount, if they were to sell this year, would put them in a higher tax bracket. And with all the depreciation, recaptured depreciation would be a bigger tax hit. So like I said, I'm not an accountant. Everyone's situation is different. Everyone's tax rate, marginal tax rate, effective tax rate is different. So it just could be that the seller wants to minimize their tax burden and not sell all at once. All right, so you go, Mr. Seller, let's say I pay you $15,000. That's the down payment. And it just so happens that $15,000 is what the seller purchased that property for many, many years ago. Again, this is just for running the numbers and giving you a couple options. So that $15,000 isn't taxable. That's essentially a return of principal. So, if you, pick any investment, whether it's a stock, a bond, a mutual fund, a real estate, whatever the case may be, if you put $10,000 in and you receive $12,000 at the end of the day, you're not taxed on that entire $12,000. That $10,000 is your cost basis, or what you put into the property. The remaining, or the leftover $2,000, that is your gain. That is what you were taxed on. So it just so happens with having a conversation with the seller, it's like, okay, so way back in, I don't know, whatever, in 1895, you got a screaming deal on this house and you paid $15,000 for it. So I'm going to pay you $15,000 here in 2022. That is a return of principal. And you would owe no taxes on that whatsoever. And we're just going to come to an agreement. And, I understand with a contract for deed, there's a little bit more risk, you being the bank. I've researched around. I could go to the bank. I could get a 5% interest loan. What if I were to offer you a little bit more? I'm going to offer you 7%. So it's 2 basis points higher than what I can get a normal bank. So you, the seller, get more money. All right, I can do that. Now, typically with any mortgage, as you probably know, the first payments for a number of years, they're front loaded with interest, and very little bit principal pay down goes to it. So the majority of that payment is going to be interest, which would be taxable to the seller. So let's just say we run this as a couple of different options. We're here in April of 2022. What if we do a moratorium that the first payment isn't due until July 1st? And that would give you 6 months of interest. Mr. Seller, I'm going to give you $15,000 down payment, which is what you paid for the property years ago. That's your cost basis. That $15,000 is not taxed. That's a return, return of premium, cost basis, a couple of different definitions for that. So $15,000 goes in your pocket to use however you wish. That is not taxable. We have payments starting in July. So instead of a full 12 months of payments, we only have 6 months of payments. So for 2022, you're going to get $15,000 not taxed. And I'm just doing this off the top of my head. I haven't run these calculations. Say for 2022, I don't know, it's a $400 a month payment. Again, I didn't run the calculations. I'm just throwing out numbers here to give you an idea. That $400 a month payment comes to, let's see, times 6. Need more coffee. Let's see, $2,400 a month total payments at a 7% interest rate. We'll just say roughly, I don't know, maybe $1,700 of that comes to interest. Again, I'm literally just throwing out numbers here. I have not calculated this. I'm sure someone in the background is running a calculator. Oh, that idiot John, he can't do that math. It's $1,600 or $2,000 for interest. I don't care. I'm just going over the numbers just to give you an idea of how this works. So, Mr. Seller, I'm going to pay you $15,000. It's going to be on a 30-year amortization with a balloon payment in 5. And the first payment's going to start on July 1st. You are actually going to be the bank, and I'm going to pay you essentially a mortgage payment, or in this case, a contract for deed. I'm going to send you a monthly payment of $400 per month going forward. All right, sounds good. So what does this mean for the seller? $15,000 upfront, that is not taxed. That's a return of principal, cost basis. Maybe about $1,700 that come in the form of interest. Again, whatever your cost basis is, work with a certified financial planner or a CPA or an attorney. But each one of these payments, there's going to be a principal and an interest tied into that. Going to be taxed differently, especially if it's factoring in a cost basis for the property. But let's just say for round numbers, that entire $2,400 of payments is taxable. So maybe for the year 2022, $2,400 total payments, not nearly as big of a tax hit as if I were to sell a property at $100,000. 2023 comes along. Mr. Seller, I'm still going to make those mortgage payments or contract for deed payments. January, February, March, April, May, so on and so forth. $400 a month. Each and every month goes in your pocket. Okay, maybe that wasn't as much as he was getting in rent, but it's still a monthly income, and it is spreading out that tax hit. So instead of $100,000 sale with all the capital gains, all the recaptured depreciation in 1 year or 2022, this is going to be coming on a multiple of years. So this is spread out then for 2022, 2023, 2024, 2025, 2026. Now we have the balloon payment due. And I say 2026 for a reason here, and it might be a little bit earlier than that. But as of now, 2026, a number of the tax rates that were lowered with the Tax Cuts and Jobs Act in 2017 are set to expire and revert back to what they were before. So up until 2026, at this point, there's essentially taxes are on sale. And I just realized I did it. So we're into 2027, so we're a year past. But this gives an option for Mr. Seller to spread out his tax obligations over numerous years instead of taking the tax hit all at once. And then the balloon payment comes up, and then the remainder comes. And maybe by that time, the seller's retired, doesn't have a W-2 job. So their main source of income is the capital gains from the installment sale or contract for deed for this property. Like I said, I'm just going off of different options just to kind of give you how this works with a contract for deed. It's a way to get started in real estate investing where the seller is the bank. You pay the seller the payments for the property, not a bank, where the bank is kind of like a middleman at this point. You take out a mortgage, bank is up here, bank sends a check for $100,000 to the seller. They're free and clear, and pays his taxes, whatever he needs to be, and then you pay the bank. Instead of this, you're cutting out the bank and then just paying the seller directly. Structured properly, and I did this a LinkedIn article about 2 years ago, how contract for deeds can be just as beneficial for the seller. I'll have a link to that in the show notes as well. So in summary, contract for deed is another way, in this way number 14 of an option to get started in real estate investing, where you can write your own terms. You can have a lot more flexibility with the payment restructure, 30-year amortization, maybe a 40-year amortization, 5-year balloon, 7-year balloon, 3-year balloon, 180-day moratorium, 3-month moratorium on the first payment. Heck, maybe you can structure it that's interest only for maybe the first year, the first 2 years, first 3 years. Then it starts on a new schedule that there's a principal payback. And with the balloon payment in 5, 6, 7 years, you refinance this property. Maybe it's worth $120,000, $150,000. Pay off the seller's balloon payment, and now you have a new mortgage with your bank and have a lot more equity in the property. Like I said, there's many ways to structure a contract for deed option that can be just as beneficial for the seller as it is for you, the buyer or the investor. So hope you learned a couple of things today in regards to contract for deeds or seller-backed financing for real estate. Be sure to hit that subscribe button and join us tomorrow for way number 15. Take care.